Today we're doing a complete breakdown of ASC 855. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Did you know a company could announce major losses after releasing its financials, blindsiding investors? ASC 855 ensures transparency by requiring disclosure of significant events after the reporting period. Understand how this standard safeguards investments by illuminating potential risks before they escalate. ASC 855 emerged to tackle the challenge of undisclosed subsequent events that could drastically alter a financial landscape. Imagine a major lawsuit filed after year-end, impacting a company's viability. This standard mandates the disclosure of such events, ensuring stakeholders are not blindsided by significant changes affecting financial assessments. ASC 855 is a mandatory guide for all entities using US generally accepted accounting principles. Effective since mid-2009, it revolutionized transparency in financial reporting. Imagine a post-balance sheet acquisition. The standard's chief mandate is to disclose such significant events, offering stakeholders insights into potential impacts, fostering informed decisions and trust. The subsequent events model is a framework for categorizing events post-reporting. Type 1 events, like a settled lawsuit with pre-existing conditions, require adjustments to reflect reality as of the balance sheet date. Type 2 events, such as a natural disaster, demand disclosure but not financial adjustments. Mastering this model highlights your expertise in ensuring financial statements are both accurate and transparent, a vital skill in any finance role. Understanding scope in ASC 855 is crucial for real-world accuracy. Candidates often forget that events after issuance of financial statements are not covered by this standard, a classic interview trap. Misapplying scope can lead to incorrect accounting treatments and financial misstatements, which impacts business decisions. ASC 855 covers events occurring after the reporting date, but before financial statements are issued. This includes recognized events that require adjustments, ensuring accuracy. For example, if a lawsuit is settled after year-end but before issuance, and it provides evidence about conditions at year-end, ASC 855 mandates adjustments. This scope ensures financial statements reflect realities affecting the reporting period. ASC 855 explicitly excludes events occurring after financial statements are issued, like a major acquisition occurring post-issuance. Future events without evidence of existing conditions are also out. For example, a market crash post-issuance doesn't affect past reporting. These exclusions are key interview traps, ensuring clarity in financial reporting and avoiding unnecessary adjustments. A subsequent event in ASC 855 occurs after the reporting period, yet before financial statements are issued. This timing can affect reported numbers significantly. For instance, a lawsuit settled 2 weeks after year-end, but before issuance, requires adjusting liabilities if it provides evidence of year-end conditions. This understanding is critical during audits and financial preparations, ensuring figures reflect true period-end realities. Recognized events under ASC 855 offer insights into conditions at the reporting date. They necessitate financial statement adjustments. Consider an inventory count revealing overstatement. If this count occurs after year-end but before issuance, it reflects conditions at year-end, requiring correction. Such recognized events are pivotal for precise reporting, ensuring figures represent actual conditions as of the reporting date. ASC 855 scope nuances often trip candidates. Consider if a customer defaults after issuing financial statements. This doesn't apply unless it reveals prior conditions. Similarly, a post-issuance contract or lawsuit is outside scope unless evidence existed at reporting date. These edge cases test your grasp on timing and condition relevance, ensuring accurate application during financial reviews. Imagine a company signs a major contract right after its reporting period ends. How should this event be reflected in financial statements? The subsequent events model is the backbone of ASC 855, guiding companies through identifying, classifying, and disclosing events post-reporting. It's all about transparency and accuracy in financial reporting. The subsequent events model is designed to ensure that any significant events occurring after a reporting period are considered in financial statements. This session will follow Meridian Corporation's $10 million SaaS contract to see how it impacts financial reporting. Each step, from identifying the reporting period end to disclosing material events, will be explored in detail to ensure full transparency and compliance. The first step in the model involves pinpointing the reporting period end date. For Meridian Corporation, this was December 31st, right before their $10 million SaaS contract came into play. This date serves as the baseline for analyzing subsequent events. A common error is neglecting this precise date, which can mislead event classification. Remember, ASC 855 emphasizes this date as the crucial reference point. After establishing the period end for Meridian Corporation on December 31st, the next step is identifying events occurring before the financial statement is issued. On January 5th, Meridian signed that $10 million contract with Acme Incorporated. A frequent oversight is missing key events in this window. ASC 855 requires capturing every event through the issuance date to maintain reporting accuracy. This sets the stage for event classification. With Meridian Corporation's post-period $10 million contract identified, the third step is classification. This contract, signed after December 31st, is deemed non-recognized since it doesn't affect conditions at the period end. Misclassification can distort financial data, a common pitfall. ASC 855 requires clarity. Recognized events must relate to existing conditions, while non-recognized are future-oriented. This classification now informs the financial impact assessment. In assessing the $10 million contract's impact on Meridian Corporation's finances, it remains non-recognized, not altering current financial statements. However, it might warrant disclosure. A typical error is overemphasizing non-recognized events immediately. ASC 855 stresses the need to promptly integrate recognized events only. This ensures statements reflect true conditions without distortion. Now, on to disclosing material non-recognized events. Finally, Meridian Corporation must decide whether the $10 million contract with Acme Incorporated, though non-recognized, should be disclosed due to its substantial future impact. A common error here is omitting significant disclosures, misleading stakeholders. ASC 855 mandates disclosure when such events could affect users' economic decisions. By disclosing material contracts, companies like Meridian ensure transparency, enhancing stakeholder trust and decision-making. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 855 requires careful selection and mandatory disclosures to ensure investors see a true picture. Understanding these rules helps finance teams avoid costly misstatements and maintain trust with stakeholders. Initial recognition under ASC 855 involves identifying subsequent events that provide evidence about conditions at the balance sheet date. These events can significantly alter financial outcomes. For example, if a legal settlement occurs after year-end but before financials are issued, it must be adjusted if material. This ensures the balance sheet reflects the true state of affairs. Subsequent measurement under ASC 855 focuses on identifying if remeasurement of assets or liabilities is needed due to events after the balance sheet date. Adjusting events, like an asset impairment from a market downturn, require remeasurement. Conversely, non-adjusting events, such as signing a new contract, are disclosed without remeasurement. This precision helps ensure financial statements remain both accurate and relevant. Presentation under ASC 855 involves carefully reflecting adjusting events in financial statements. These events might affect line items like other income or expenses, directly altering the balance sheet or income statement. Proper classification and detailed notes ensure stakeholders understand the financial impact. This transparency is crucial, especially when significant subsequent events could sway investment decisions or creditor evaluations. ASC 855 mandates key disclosures that play a critical role in financial transparency. Companies must disclose the nature and financial impact of significant subsequent events, whether adjusting or non-adjusting. This aids stakeholders in making informed decisions. For instance, explaining a major post-balance sheet acquisition helps investors grasp potential impacts on future earnings. These disclosures ensure clarity, allowing analysts to comprehensively evaluate a company's financial health. Picture a CFO managing a $2 million lawsuit settlement that occurs after the balance sheet date, but before financial statements are issued. Under ASC 855, this is an adjusting event, requiring the CFO to update the financials and disclose the settlement details. By articulating the financial impact in the notes, the CFO ensures investors and analysts have a complete understanding of the company's situation. This transparency fortifies trust and supports accurate financial analysis. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Understand the impact on financial statements, adjustments, and the eventual derecognition of the lease. Under ASC 855, Meridian recognizes a right-of-use asset and a corresponding lease liability for the warehouse lease. This ensures the lease is accurately reflected on the balance sheet, impacting both assets and liabilities by $1,200,000 initially. Meridian reduces its lease liability by $20,000 with the first payment. ASC 855 requires this to lower the liability on the balance sheet, ensuring that cash outflows align with liability reduction, maintaining financial statement accuracy. Recording amortization aligns with ASC 855's treatment of right-of-use assets, reducing the asset over the lease term. This monthly $20,000 expense impacts the income statement, reflecting the cost of using the leased asset over time. Interest accrual on the lease liability shows how ASC 855 captures the cost of borrowing. This $5,000 increases the lease liability, reflecting interest over time and impacting net income as an interest expense. Quarterly revaluation adjusts the lease liability and right-of-use asset by $3,000. ASC 855 mandates these adjustments to maintain accurate financial representation as market conditions change, impacting asset and liability valuation. Annual lease expense recognition ensures comprehensive expense accounting for the year. ASC 855 requires this $240,000 recognition to capture the full leasing cost, aligning lease expenses with actual cash outflows for accurate financial reporting. ASC 855 requires impairment tests to ensure assets aren't overstated. This $15,000 adjustment reflects current fair value, preventing asset inflation on the balance sheet, and ensuring a realistic financial position. Settling the lease liability closes the lease agreement. ASC 855 mandates this $1,155,000 payment to fully extinguish the liability, reflecting no further obligations. This impacts cash flow and finalizes the lease's financial treatment. Derecognizing the right-of-use asset completes the lease lifecycle under ASC 855. This $1,200,000 entry removes the asset from the balance sheet, reflecting the conclusion of asset use and clearing accumulated amortization. Every Big Four and investment bank interview on ASC 855 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 855 covers subsequent events, guiding what to report between the balance sheet date and report issuance. It ensures financial statements reflect relevant changes. A common mistake is ignoring non-recognized events. Remember, ASC 855 helps users understand events that could impact financial health post-reporting. Subsequent events are crucial because they can significantly affect a company's financial outlook. ASC 855 ensures these events are reviewed for potential recognition or disclosure. For example, the post-balance sheet lawsuit settlement could alter financials. Ignoring these can mislead stakeholders. Always evaluate events for impact on financial statements. If a lawsuit is settled after the balance sheet date but before the financial statements are issued, the settlement is a non-recognized subsequent event. ASC 855 requires disclosure if material, not adjustment. Mislabeling it as recognized is a trap. Remember, disclose material impacts, don't adjust prior statements. Bankruptcy of a major customer after the balance sheet date but before financial statement issuance requires evaluation. If it provides evidence about conditions at the balance sheet date, it's a recognized event. Misclassifying it can lead to inaccurate financials. Always assess timing and nature of events for proper categorization. ASC 855 and Indian Accounting Standard have similar frameworks for subsequent events. But Indian Accounting Standard requires disclosures in more detail. A common pitfall is overlooking these detailed disclosures in Indian Accounting Standard. Ensure comprehensive disclosure to comply. Always check the latest guidance on the subtle differences to avoid errors. ASC 855 and International Financial Reporting Standards both address subsequent events, but International Financial Reporting Standards has broader disclosure requirements. International Financial Reporting Standards requires events affecting future operations to be disclosed, even if not recognized. This broader scope can catch candidates out. Always note International Financial Reporting Standards' extensive disclosure needs when preparing comparative statements. Natural disasters post-balance sheet are typically non-recognized events, unless they provide evidence of conditions at the balance sheet date. ASC 855 requires disclosure of estimates for material impacts. Misjudging recognition can mislead stakeholders. Always calculate potential financial impacts for accurate disclosure without altering the existing financials. ASC 855 doesn't cover stock splits announced after the balance sheet date as recognized events. They don't provide evidence of conditions at the balance sheet date. However, disclosure may be necessary due to potential investor impacts. Misjudging its scope can be costly. Always check for disclosure requirements. CFOs must disclose subsequent events impacting financials post-balance sheet, but pre-issuance. ASC 855 mandates disclosing the nature and financial impact if material. A common trap is failing to disclose a non-recognized but material event. Ensure all potential impacts are clearly communicated to stakeholders, maintaining transparency and compliance. Confusing recognized and non-recognized events under ASC 855 is a typical trap. Recognized events impact financials directly, while non-recognized only require disclosure if material. Misidentifying them can lead to incorrect financial adjustments. Remember, disclosure, not adjustment, is key for non-recognized events. Always determine event impact correctly. ASC 855 centers on recognizing significant events post-balance sheet date. It applies universally under US generally accepted accounting principles, distinguishing between recognized and non-recognized events, like a litigation settlement or a new share issuance. Recognized events impact existing conditions, while non-recognized ones arise later. Disclosures are necessary for non-recognized events that might influence decision-making. The model under ASC 855 divides events into recognized and non-recognized for adjustments and disclosure. Recognized events like litigation settlements adjust financials. Non-recognized events don't alter financials but may need disclosure. Public companies assess events until financials are issued, while private entities consider them until available for issuance. For interviews, understand ASC 855's nuances. Misclassifying events can cause reporting errors. Disclosure is vital for significant non-recognized events. Differentiation from international financial reporting standards is key. Public and private entities face distinct evaluation periods. Management's proactive role in assessing subsequent events ensures compliance and accurate financials, avoiding pitfalls that lead to misleading reports. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.